Chapter 1. The day the border became a spreadsheet. Let us begin with a thought experiment that everyone insists is impossible, which usually means it is overdue. One morning, the border between Singapore and Malaysia does not close. It updates. No tanks, no flags, no speeches about destiny, just a PDF, a joint economic harmonization framework. 400 pages, 8 appendices, 12 footnotes that quietly rewrite history. Singapore is not conquered, it is absorbed. The way a hedge fund absorbs a distressed asset. The way a spreadsheet absorbs human lives and converts them into columns labelled productivity, housing stock, tax efficiency. The press calls it regional optimization. Markets call it interesting. Retail investors call it too late. When sovereignty becomes an asset class. On day one, the currency does not collapse. That would be vulgar. Instead, analysts announce a temporary dual denomination period. Translation: your savings are now a theoretical concept. CPF balances are suddenly discussed the way emerging market pensions are always discussed, with concern, sympathy, and absolutely no intention of protecting them. Singaporeans, raised to trust institutions like religions with air conditioning, stare at dashboards that still load, but show new numbers. Lower numbers. Real estate reacts first, because real estate always reacts first. Condos that once sold on proximity to MRT stations are now evaluated on cross-border demographic yield. Johor developers smile politely. Singapore property agents develop sudden spiritual beliefs about patience. Prime districts remain prime, of course. Wealth is very loyal to itself. But the middle, the HDB miracle, the myth that obedience converts into stability, that story is quietly delisted. Stocks go up, people go sideways. The stock market loves the merger. Banks issue research notes titled Unlocking ASEAN Synergies. Brokerage apps push notifications full of fireworks emojis and words like scale. Blue-chip companies are re-rated as regional champions. Conglomerates announce restructuring plans that involve layoffs described as talent mobility. Foreign funds applaud. Domestic workers refresh their LinkedIn profiles and discover that competition now includes people willing to work for less, complain less, and wait longer. GDP looks fantastic. Per capita stops being mentioned. The new geography of winner's capital flows north. Labour flows everywhere else. Singapore's financial district remains intact, polished, and strangely quieter. The decisions are still made there, but the consequences are exported. Malaysia gains leverage, population gravity, and manufacturing narrative. Singapore gains a new role, headquarters without hinterland anxiety, except now the hinterland has voting power. No one says annexation, they say integration. Integration is what happens when borders disappear, but hierarchies do not. The uncomfortable math. Here is the equation nobody tweets. High trust plus high density plus high compliance minus political insulation equals a very efficient adjustment shock. Singapore was optimized to function, not to resist, and resistance is expensive. Why this story feels real? Because nothing dramatic happened, because markets approved, because the language was soothing, because the numbers made sense, because every step was rational, and because by the time people noticed that something fundamental had shifted, the charts were already updated. If this is already making you uncomfortable, good. That means you are still paying attention. This series will go deeper, into housing, into debt, into capital flight, class flight, and the strange silence that follows. Chapter 2. When property became politics and markets learned to lie. At first, officials insist nothing fundamental has changed. Housing, they say, remains stable. Prices are adjusting. Demand is diversifying. These are comforting words. They mean nothing. Because the moment Singapore is folded into Malaysia, property stops being shelter and becomes strategy. not investment strategy, political strategy. The death of the HDB promise. The old promise was simple: work hard, obey rules, queue correctly, get a home. That promise depended on one fragile assumption: control. Once housing policy answers to a broader federal logic, the math changes. Population pressure is no longer local, supply is no longer moral, priority is no longer yours. HDB flats do not collapse in price. That would cause panic. They simply stop rising. And in a system built on perpetual appreciation, stagnation is a polite word for loss. Middle-aged owners discover that their retirement plan has become a case study. Young buyers discover that waiting no longer improves affordability because demand is now regional and patience is no longer rewarded. Developers pivot, not toward citizens, but toward buyers. Citizenship becomes sentimental, liquidity does not. Condos for capital, not people. Luxury real estate does beautifully. Of course it does. Capital always survives mergers. Units are marketed in Kuala Lumpur, Shanghai, Dubai. Brochures replace neighborhood maps with yield charts. Lifestyle is replaced with exit options. Nobody lives there. Everyone owns a piece. Singapore's skyline remains pristine, but emptier. Lights on, curtains closed. A city optimized for balance sheets, not birthdays. Stocks rise, because they must. Markets, meanwhile, perform optimism. Banks publish reports celebrating scale, integration, and efficiency. Indices rise on schedule. ETFs rebalance automatically. Retail investors sense something is wrong but cannot articulate it. The numbers are green. Their lives are not. This is when markets stop being mirrors and start being theatre. Layoffs are framed as reallocation. Wage pressure is described as competitiveness. Household debt is ignored because it does not trade publicly. Foreign investors are thrilled. Domestic investors are confused. Workers are told to upskill into positions that do not exist yet. Debt. The quiet winner. Household debt climbs politely. Credit remains available. Interest rates stay just low enough to prevent rebellion. People refinance, not to grow wealth, but to maintain dignity. Cards replace cash. Loans replace certainty. On paper, consumption continues. In reality, resilience is being sold off month by month. Debt does not scream. It whispers. The class border nobody voted for something subtle happens next. The wealthy adapt instantly. Assets are diversified. Residency becomes optional. The middle freezes. Too asset-heavy to move. Too income-light to compete. The poor become invisible, absorbed into statistics labeled regional variance. The border never closed, but a new one appeared anyway. It runs between those who own appreciating assets and those who are told to wait. The lie. Everyone agrees to tell officials insist this is progress. Markets insist this is efficiency. Media insists this is inevitable. And everyone quietly agrees not to ask the obvious question: who exactly is this system for now? If Chapter 2 feels less fictional than Chapter 1, that is not an accident. This is where numbers start winning arguments against people. Chapter 3 goes further, into currency reality, capital flight, and the moment when savings realize they are trapped. Chapter 3. The currency didn't collapse. It was repriced. Currencies do not scream when they lose power. They clear their throats, adjust decimals, and pretend nothing personal happened. After the absorption, officials announce a managed convergence mechanism. Economists nod. Traders smile the way surgeons smile before anesthesia. The Singapore dollar is not abolished. That would frighten people. It is benchmarked. Benchmarked to productivity. Benchmarked to competitiveness. Benchmarked to a future that looks suspiciously cheaper. Dual currency, single direction. For a while, both currencies circulate. The Malaysian ringgit is described as supportive. The Singapore dollar is described as overperforming historically. That sentence does a lot of damage quietly. Savings accounts still show the same numbers, but purchasing power develops a limp. Imported goods cost more. Overseas tuition suddenly feels aspirational. People blame inflation. Inflation blames external factors. Nobody blames policy because policy is framed as math. Capital learns to leave before people do. Money is faster than humans. High net worth individuals move first, not dramatically, just small adjustments. A family office here, a trust there. Residency options reviewed for the children. Capital flight is never announced, it is inferred. Banks notice deposits shrinking at the top end while consumer loans grow at the bottom. This is called financial inclusion. The illusion of stability authorities reassure the public. Reserves are strong. Liquidity is ample. Confidence remains intact. All of this is true and irrelevant because confidence is not about numbers. It is about whether people believe tomorrow will resemble today. At this stage, nobody panics. They simply stop planning long term. Marriage is delayed. Children are postponed. Careers become temporary strategies instead of identities. A society that once optimized for the future begins optimizing for flexibility. That is not resilience, that is retreat. Markets applaud again. Equity markets rally. Exporters benefit from favorable exchange dynamics. Multinationals enjoy lower effective costs. Analysts upgrade targets. Retail investors buy the dip because they were taught that discipline always wins. What they were not taught is that discipline assumes the rules stay local. The index looks healthy. The median household does not. Savings discover gravity. Fixed deposits roll over at rates that barely outrun erosion. Pension projections are quietly revised. Nobody loses everything. That would be scandalous. Instead, everyone loses a little, consistently, politely, over time. This is how wealth is redistributed without legislation. The psychological break here is the real turning point. People stop asking, "How do I grow?" They start asking, "How do I preserve?" That shift kills dynamism faster than any recession. Entrepreneurship becomes risk management. Innovation becomes cost-cutting. Talent looks abroad not for opportunity, but for insulation. The city still works. It just no longer dreams. The question nobody asks out loud. If currency is trust, and trust is expectation, then what exactly is being defended now? A symbol? A memory? A balance sheet? Because the moment savings feel trapped, loyalty becomes optional. Chapter 4 goes where this inevitably leads. Taxes rise without rising. Compliance tightens without debate, and governance becomes an exercise in managing disappointment. Taxes rose without rising, and nobody voted anyway. Nobody announces a tax hike. That would cause opinions. Instead, the system becomes more accurate. After integration, authorities promise continuity. Rates stay the same, thresholds remain competitive. Forms look familiar enough to avoid alarm, and yet somehow everyone pays more. The art of invisible taxation. Welcome to the golden age of efficiency-based extraction. Deductions are simplified, which is policy language for removed. Rebates are consolidated, which is accounting language for delayed. Compliance windows narrow, penalties widen. Automation ensures that errors are now instant and unforgiving. Nobody argues because the system is correct. Correct systems do not negotiate. CPF contributions are harmonized. Benefits are recalibrated. Timelines are under review. People still contribute. They just stop believing they will get the same deal their parents did. Compliance is the new patriotism. This is where Singapore truly shines. A population trained for rule following adapts flawlessly to expanded oversight. Forms are submitted early, apps are updated, biometrics are accepted with polite nods. Integration does not require force when compliance is cultural. In Malaysia, policymakers marvel at the efficiency. In Singapore, People quietly wonder when temporary measures become permanent architecture. Fees, levies, contributions, not taxes. Public transport fares adjust for cost alignment. Healthcare co-payments shift for sustainability. Licenses acquire processing fees that did not exist last quarter. None of these are called taxes. They are user responsibilities, a perfect system. You only pay when you exist. The middle pays for stability. The wealthy barely notice. Structures absorb increases the way insulation absorbs heat. The poor receive targeted assistance, means tested into dignity-free compliance. The middle pays everything else. Not enough to riot, just enough to stay tired. Disposable income shrinks, but gradually. Savings continue, but reluctantly. Spending persists, because stopping would feel like surrender. This is how stability is financed. Governance by dashboard decisions are no longer debated. They are optimized. Dashboards replace speeches. KPIs replace empathy. If the metric improves, the policy is justified. If people suffer, the metric did not notice. Elections still exist. They just feel ceremonial. Policy is framed as inevitability. Opposition is framed as irresponsibility. And everyone learns the same lesson. Adaptation is safer than objection. The emotional tax here is the cost nobody budgets for. People stop feeling entitled to the future. They start renting it emotionally. Careers are transactional. Homes are provisional. Citizenship becomes administrative rather than aspirational. The city still functions, but it no longer forgives mistakes. The silence. After acceptance. Once people accept that the system will always ask for more while promising stability, something breaks quietly. They comply, they optimize, they disengage. A perfectly managed society can still feel abandoned. Chapter 5 is the final one. This is where exit strategies replace loyalty, where identity becomes optional, and where the question changes from what will happen to who gets out first. Chapter 5. Exit. Was not a protest. It was a spreadsheet decision. Nobody announces they are leaving. They say things like, just diversifying, just keeping options open, just for the kids. This is how loyalty ends in the modern world, not with anger, with planning. Exit is not emigration anymore. In the old world, leaving meant departure. In this one, it means optional presence. People keep addresses, they keep accounts, they keep compliance. What they move is exposure. Income streams go offshore first, then savings, then attention. Physical relocation becomes the last step, not the first. The passport is still valid. The emotional investment is not. Citizenship becomes a utility. After absorption, citizenship loses its romance. It becomes access. To healthcare tiers, to tax brackets, to queues that still move faster than elsewhere. People stop asking, where do I belong? They ask, where am I most efficient? That question sounds cold until you realize it was taught. Who leaves first? Not the angry, not the poor, not the loud. The quiet winners leave first. Professionals with portable skills, families with multilingual children, asset holders who already think in currencies, not flags. They do not announce their exit. They simply stop anchoring their future to one system. What remains is a population that still works, still pays, still complies, just with fewer people imagining long horizons. The final illusion, stability. From the outside, everything looks fine. The skyline shines, the trains run, the indices hold, investors remain impressed, tourists remain convinced. But inside, the national mood shifts from ambition to maintenance. Maintenance of lifestyle, maintenance of dignity, maintenance of appearances. A country can survive that way for a long time. It just stops surprising the future. The question that lingers. So what if Singapore were absorbed by Malaysia? Nothing dramatic, nothing cinematic, nothing that would trend for more than a week. Just a series of rational decisions that, added together, change who believes the system is for them. That is why this fiction feels uncomfortably real, because no villain was required, only incentives. Final thought: nations do not fall anymore, they rebalance. People do not revolt, they reallocate. And history does not announce turning points, it invoices them monthly. If this series made you uneasy, good. Unease means awareness still works.